Good morning. Welcome to the XM.com weekly market update. And we're joined once again by Peter McGuire, the CEO of XM. Pete, Happy New Year and welcome back.
Welcome back, Andrew, and Happy New Year, all right. What a new year it's going to be.
Well, yeah, it was 2022. It was a wild ride from a whole range of perspectives.
Yeah.
Probably one of the most volatile years we've had for quite some time.
Yeah, across nearly every asset class.
Certainly has. But once again, we get back into the 2023 numbers. Plenty of data starting to come out now. It was a fairly slow start that first week of January, and the markets behaved pretty well generally. It was a sort of, you'd say it was a positive start. Very early days, of course. But if we look at the on the domestic front, the Aussie building permits came out year on year. There's some pretty drastic numbers there. The last one has come out at sort of negative 15%, which was a lot higher than they were expecting. But if you look at that chart, that gives you the impact of higher interest rates.
Exactly right, and the impact, of course, to tradespeople and construction industry and all those supply chains from, delivering a fridge to a new apartment or prospective, off the plan buying. Yeah, it certainly is. It's cratered, and let's see how 23 rolls for the construction industry.
Thank you very much. Following on from that, we've got the Aussie dollar. Quite a recovery.
Wow. That chart says it all. We were talking off screen, and if you traded one market and one market only last year, it was the Aussie versus US. Look at that high of 76 cents. What we saw in April, we used to say, is it fully priced? Cratered all the way through to nearly 60. Bounced in early November with the US dollar coming off dramatically, and you're at 69. I'm looking at the screen now. It's big time what we've seen over the last matter of couple of days trading. We're at 69.12. Very strong.
Yeah, and as you say, you only look back a week or so, it was sort of around close to that 66 mark. So it's certainly picked up. But once again, as the US gets a bit weaker, the other currencies.
That US dollar index, we're at 103.15, I think, at the moment right now, and we were nearly through 103 about 4 o'clock this morning, I look. So, everyone's saying 102 is going to be the handle. We've got a big meeting, by the way, this week in Sweden. Are you flying over for that one?
I won't be, no.
You won't be? Okay, well, they've got the Fed chair pals there. You've got the English finance minister. You've got Kuroda from Japan, Bank of Japan. You've got the Swedish, and a number of other different central bankers that are going for that symposium. So we want to see the sentiment, we want to see rhetoric and the storyline of, really what's happening to King Dollar.
Yeah, certainly. So moving forward, we can look at the oil prices.
Yeah.
So once again, you look at that, that's going back over 12 months, and it's a little bit higher where it was 12 months ago, but not by much. And that was one of the big drivers for the inflation
story, yeah. And what we saw from a geopolitical front with Ukraine, Russia, heating oil issues, supply chains, China, you name it, and of course the impact as far as Russia being paid for alternative currencies and back at that rebase of 100. But all I'll say is if 23 does what 22 did, then it's going to be a volatile year. So no one knows yet, but I think volatility will remain for the energy markets.
Yeah, and I think if that does pick up, we can look at sort of the China numbers as well. That's starting to come back into play now with the, first of all, zero COVID policy gone.
Yep.
Reopening effectively, I think it was just this week with the borders effectively. So now obviously they've still got a huge COVID issue, so that's going to curtail manufacturing, you would sort of think, for the foreseeable future. And their GDP has picked up a bit, but it's not...
nowhere like it was.
No, not at all. But once that does pick up, then potentially that's going to put the heat maybe back into the oil prices.
I think so. I'm looking at the second half of this quarter, and the reason is because you've got Lunar New Year only 3 weeks away or less for the Chinese. Everyone's going home. Everyone you talk to is, you guys are based in Chinatown. The locals around here are all heading back to China, haven't been there for a number of years to see family and how everything's going back on the mainland.
Very much so. Eurozone inflation.
Wow.
We were talking that number a few months ago could have gone anywhere.
Yep.
So, and we're sort of seeing this in a lot of the economies at the moment where the sting is coming out of that inflation number.
Due to weaker energy prices, certainly. And 9.2, big, haircut compared to that 10.1. It's a good move to the downside. So let's see if that continues and those big drops. Time will tell. It's going to be a great year to wrap this show up every week. What we discuss That's quite informative.
Yeah, and I think like the higher interest rates clearly are starting to kick in now.
You bet.
In all the major economies. So,
Yeah.
and we look at Eurozone year-on-year retail sales.
It'd be nice having a retail sale in Berlin. Wouldn't
Yeah,
it?
so you look at that, the last 6 months, effectively negative the whole way through. So,
Yeah.
not great numbers there, but no surprise.
No, not at all. And we understand the weakness of the Eurozone and the overall economy there. And I think it's only going to be tougher. You've got a lot of big firms that are starting to downsize. We were talking Goldman Sachs, 3,200, Amazon, 18,000. So this is all going to wash through. And as we know, that what you've got in your spending power, if you've lost your job, you're not going to be out there retail sales.
No, not at all. So, PMI came out last week.
Yeah.
The chart tells the story.
Yeah, it does. I mean, there's a 48. Anything under 50 for everyone out there as a contraction, and that's just above 48. So that's not a good sign. I want to see where that is by really Easter. Yeah. The first 3 months of this year. Yeah, you keep on forgetting it's 2023. January, February, March. I just want to see where that runs, and if we're going to see further contraction, that's not a good sign for the US.
Job creation, this is the non-farm payrolls. Came out last week. Once again, those figures have been pretty steady over the last few months.
Yes, they have.
But yeah, it's sort of interesting. Probably speaking earlier, the labour market's probably that last dominator fall. Yeah. And it looks as though that is...
Well, it's the lagging indicator. It's the human touch. 223,000 was our number we hit in December.
Yes.
It was our weakest number for the year. And we can see that it's slowly tailing off. If it can remain above 200,000 again in that first quarter, then I think that's not a good, that is a reasonably good sign. But time will tell, Andrew, and the impact naturally to US equities and what's happening with King Dollar.
Yeah. And I think playing into that lagging indicator, we look here for the US job openings, it's still clearly more than the unemployed. So like we've said for many, many months, if you want a job, you will get one.
Yes.
But it'll be, this figure will be really interesting over the next, probably over that first quarter to see if that gap closes.
Exactly right, if it narrows, and time will tell. 23 is going to be a very fascinating year.
Now, finally, I thought we'll just do a quick wrap of 2022. Now, this has got all the major indexes, commodities, Bitcoin, etc.
Yeah.
So it gives you a really good snapshot of what's happening in 2020, which was a crazy year anyway with the pandemic.
You bet.
The way the markets sold off and then recovered, and some.
Yes.
They hung in there in 2021, and then obviously as the inflation kicked in 2022, that's where we saw the pain. So
yes, of course.
But it just gives you an idea. So, like some of those big numbers there, like you look at the Nasdaq, where 2020 up 43%, which is
monstrous, wasn't it? Yeah, we were talking then, and it was just incredible. Every week, just hitting big numbers, nearly up, 0.8 or nearly 1% a week.
Yeah. So, but I think that it gives you a really good snapshot of what the market did last year. So obviously everyone knew it was very volatile, but I think moving forward, it'll be interesting to see how things play out. We've got the CPI numbers coming up shortly.
Yep.
Moving into earnings season again, so that'll be interesting to see how some of those bigger companies have performed over the final 3 months of the year.
Yeah, for sure. We've got GDP coming out of UK. I want to see how that rolls, and naturally retail sales and the overall picture as far as that Eurozone UK versus the States and those themes with market sentiment. That's why this week I think is going to be crucial. What they say in Sweden could be a real doorbell for traders to look at and go, okay, if they're going to keep on ratcheting rates, and that's the rhetoric coming out, then how do they play the currency trading game?
Yeah. Well, that's the interest rate's a big player as well.
Yeah.
And you would sort of think they've got to be fairly close to the top, you would think.
You would think.
Otherwise, it could send things over a cliff. But we'll see. I suspect they'll talk tough, which they want to do. Whether or not that relates into action further down the track. There will be more rises. Will they be as drastic as what people are anticipating?
Signal, not noise.
Time will tell. But anyway, so that's our first XM update for the year. So Pete, thanks for coming back in.
Thank you, Andrew. Lovely for the invite.
Catch up again next week.
Look forward to it.
And that's the XM.com weekly market update.